Hi, my name is Jordan Frew, and I am discussing the AT&T cost of capital analysis for Professor Shiroki, Finance 139. So for the first question, we were asked to calculate the interest-bearing short-term debt and the average cost of debt. These numbers will be in millions. So short-term debt was $6,056, and the average interest on that was $420. Note 8, obligations listed that interest-bearing short-term debts totaled $6,056 in millions in 2014 with a weighted average interest rate of 4.2% in 2014. For the second question, we were asked what was AT&T's actual capital structure at the end of 2014 and what portion of AT&T's capital structure did not have short-term debt, long-term debt, and stockholders' equity. So short-term debt was already discussed in the first question of $6,065. So out of that, the proportion to the long-term capital was actually 3.53%. Long-term debt was 44.25%, and then shareholders' equity was 52.22%. For the third question, we had to recalculate AT&T's capital structure just using long-term capital. For example, long-term debt and common equity. So then we had to calculate the long-term debt to total long-term capital ratio and the common equity to total capital ratio. So the long-term capital ratio was 45.87%, and we calculated that by taking the long-term debt and we divided by long-term debt plus common equity. The equity to total capital ratio is debt divided by shareholders' equity plus debt, and therefore the equity to capital ratio was 47.78%. The fourth question, we had to assume that AT&T wanted to issue fixed rate of 10-year bonds, and if their investment bankers tell the firm that they want to do it at a spread of 1.5% premium, greater than the equivalent maturity treasury security, we had to calculate what the before-tax cost of the long-term debt was. So the yield was 1.90% for the 10-year bonds, and then once you added in the premium spread, the cost of long-term debt ended up being 3.40%. So for the fifth question, we had to calculate the after-tax cost of short-term debt and long-term liability. So the effective tax rate in 2014 was 34.60% for AT&T, and then the before-tax cost of short-term debt was 3.53%. So how you calculate the after-tax cost is you take the before-tax rate and you multiply it by 1 minus the marginal tax. And once we calculated that, it was 2.75%. The after-tax cost of long-term debt, that's the same formula, and I ended up getting 2.22%. The higher the tax, or the higher the cost of debt for a company, the more risk a company will possess. AT&T has a relatively low cost of debt, so in both short and long term, so it's less risk overall. For the final question, we were asked to apply the capital asset pricing model's security market line to estimate for AT&T. We were to use the ask yield on a 10-year T-bond as an estimate, and the beta for AT&T was 0.278, which is relatively low, and the yield on the T-bond that we were going to use is 1.90%. The market premium was given to us in the problem, that was 7%. So therefore, the capital asset pricing model ended up being 3.85%. The low beta of the company indicates that the company has extremely low risk, which allowed the CAPM model to be so low. And that's it for the cost of equity and the cost of debt for AT&T.